Here are 5 questions you absolutely must ask before choosing a hard money lender. Because picking the wrong lender can cost you thousands, slow down your project, or even kill your deal entirely. And this is something I unfortunately see all the time. My name is Aidan. I'm a hard money lender who has completed millions and millions in loans for hundreds of real estate investors. And one of the biggest mistakes I see is investors focusing only on the interest rate instead of understanding the full picture. So today we're breaking down the 5 questions you need to ask before you use a hard money on a flip, BRRRR, or any other project. Let's jump in. So question number 1, what are your total costs? Not just the interest rate, the total cost of the loan. Some lenders advertise a lower rate, but then they stack on the origination fee, processing fees, underwriting fees, appraisals fees, exit fees, draw fees, attorney doc prep fees, funding fees, the list goes on. You need to know everything. Let's just look at a simple example. Let's say you're borrowing $200,000 for 6 months. Lender 1 offers a 10% interest and 2 points and $1,000 in processing. So 2 points on $200,000 is $4,000. 6 months of interest at 10% is $10,000, and then you add the $1,000 processing fee. This means that the total cost to borrow the loan is $15,000. Now let's look at lender 2, who has a 12% interest rate, no origination points, but they have $4,000 in miscellaneous fees. So 6 months at 12% interest, that's $12,000. Then you add the $4,000 in fees. This makes the total cost at $16,000. So the no points lender actually costs more, although they advertise what might look like less. So this is why I always tell investors, don't look at the rate alone or the points alone, look at the entire structure. If you're currently comparing lenders and want to see what we would structure for your deal, you can click the first link in the description and reach out directly. Question number 2, what are all their lending thresholds? Based on your experience and credit, what tier do you fall in and what leverage thresholds apply? There are 3 main leverages to be mindful of: LTV, LTC, and LTARV. And all 3 need to work together for the loan to work. LTV looks at the value as is, which most lenders will cap at 80 to 90% for the LTV or LTP, loan to purchase, whichever is the lesser. LTC looks at the total cost, total of purchase plus construction, which most lenders will cap their total loan at 80 to 93.5 LTC. LTARV looks at the loan in comparison to the after repair value, which most lenders have a cap at about 75% of ARV. So for a $1 million ARV, their max loan would be $750,000. I know this could be a little confusing, so let's talk about an example. So for a purchase of $500,000, a rehab of $200,000, and an ARV of $1 million, let's look at how these leverages come into play. If the value of the property comes in at or above $500,000, the lender will give their full purchase LTV, whether that's 80 or 90% of the purchase number. If the value is lower than their purchase, let's say it came in at $450,000, then the lender will only give their LTV leverage on the true value, that $450,000 number, which means the borrower will have to bring in a higher down payment amount. So for LTC, loan to cost, with the same scenario, the purchase plus construction equals $700,000. 500 purchase, 200 rehab. So in this hypothetical scenario, the lender has a 93.5 loan to cost, which means the max loan would be $654,500. If we had the same hypothetical lender offering 90% LTV on the purchase plus 100% of the rehab, which is normal for rehab leverage, we would have a $650,000 loan, which means it's under their loan to cost threshold. Lastly, for LTARV, with this scenario of a $1 million ARV, the likely max loan based on an LTARV of 75% would be $750,000, which our loan amount of $650,000 falls within. So that's another green flag for the loan mechanics. If the ARV came in lower at, let's say, $800,000, that would put the max loan at $600,000, which our full leverage loan of $650,000 would exceed. So what happens in those scenarios? In that example, the initial leverage or the LTV would be lowered to make sure it does not exceed the max loan that's given from the LTARV thresholds. The lender would require the LTV to be lowered to 80% instead of 90% in order to stay within that 75% LTARV. Whenever you hit caps on LTC or LTARV, it is the initial LTV that gets lowered in order to accommodate. I know that can be tricky to understand, but once you do grasp this concept of LTV, LTARV, and LTC, you can fully understand how a lender looks at the loan, and you can see how the lender determines how much capital you actually get. So our LTV, LTARV, and LTC thresholds are typically higher than the larger majority of our competition. What this means is that you get more leverage and lower down payments to get into properties and scale. If you want to know our exact metrics for your scenario, reach out to us in the link below and connect with one of our loan officers to discuss more. So the next question is, how does a lender determine the value? How are they calculating the as-is value or the ARV? Are they ordering an appraisal, using internal valuation models, ordering a BPO, then are they applying conservative buffers to whatever those values come in at? Let's say one lender uses an appraisal and your deal comes in at $300,000 as is, and then another lender uses their own internal valuations and it comes back at $250,000. At 90% LTV, the first lender would give you a loan of $270,000, 90% of the $300K. And then the other lender who had the internal valuations of $250,000 at the same 90% metric would only give you initial loan of $225,000. That's a $45,000 difference in loan amount, and that means $45,000 more out of your pocket to get into the loan. So the questions you need to ask a lender to understand their valuation method would be, do they need a full appraisal, or are there other forms of valuations? There are pros and cons to having a full appraisal. Usually the appraisers are more knowledgeable in the local market, which tends to have values coming in less biased and more accurate, but can also take longer than other forms of valuations, like desktop appraisals or internal valuations. That said, oftentimes investors run into situations where appraisers are the reasons why a deal dies because the value is not clear enough through the comps in the market and the value comes in lower than the investor anticipates. This adds even more to the reasoning of why it's better to choose deals with strong market support where value can clearly and definitively be found and supported. Another question that I would ask would be if the appraisal goes through an AMC, stands for Appraisal Management Company, which is a third-party intermediary, and then your loan amount gets lowered because they end up dinging the values based off of what they see. This valuation methodology drives your leverage, and leverage drives your return. So it is ultra important that you understand how the lender views this. The fifth question to ask your lender would be, how do draws work? This might be the most important question that rarely gets asked. Let's say you have $50,000 in rehab funds held in escrow. You need to know, are draws reimbursed or are they advanced up front? Do they require inspections? How fast are funds released? What are the draw fees, if any? Are the inspections virtual or in person? Do they require lien waivers? These are all questions that lend to the speed or ease of being able to access your rehab funds. If draws take 2 weeks to process, your contractors may leave for another project. I've unfortunately seen that happen with some investors before. So speed matters, and access to capital during renovation matters. Make sure you understand the draw system before you close. So here are some final thoughts, right? Before choosing a hard money lender, ask, how is valuation done and ARV and as-is value determined? Are there any prepayment penalties? Lastly, how do draws work? Hard money is a powerful tool when structured properly. We funded millions in hard money loans for hundreds of investors, and the difference between a good deal and a bad deal often comes down to the lender structure. If you're working on a deal and want us to look at it, click the first link in the description and connect with us directly. Make sure your lender is aligned with your timeline, your leverage goals, and your exit strategy. Thank you guys for watching, and we'll see you in the next video.